pages. It's on the third piece of paper. So exercise 1850. And this is the one that we started to do in class for the 4 p.m. class and struggled with it. So what have we got this time? We've got the records of Anderson, Inc. First thing they're telling us is there's no beginning balance in the deferred tax asset account. So that's good. We won't have to deal with that. Taxable income is $60,000. Okay, so we know that that should drive the payable, right? So that's the taxable income number. Tax rate is 25%. We'll come back to that though. And we've got 3 temporary differences. Now again, the key that I want you to remember that I feel like I did not give you a great approach in class, that I want you to redo your approach and look at them this way, is that you're going to take each one and look at your GAAP versus your tax basis. So in the first one, we've got an estimated litigation accrual. So I'm going to actually do a T account for each of these, because in some of the problems, maybe not this one, but in some of them, they tell us that some things have changed. So we've got litigation, right? And for GAAP purposes, it tells us that the litigation accrual is $20,000, not deductible for tax purposes. Settlement will not take its place till 2022. Okay, so we don't have that accrual for tax, for litigation. Then we've got a depreciation issue. So we've got excess of accelerated depreciation over GAAP of $12,000, caused a difference in the $50,000 GAAP basis and the $38,000 tax basis, right? So I can draw that out too. I can just draw my equipment, right? And we know in this difference column, they just told us that the total difference is $12,000. And then they came back and told us that we had a $50,000 GAAP basis in our equipment and $38,000 for tax, right? So we've been accelerating the amortization for tax purposes. All right, next one, we've got a equity holding. Okay, so remember with equity holdings, right, we learned in FR1 that sometimes even though we haven't sold it, we need to recognize a gain or loss in the income statement depending on what method we've chosen. So in this case, they tell us an unrealized gain on an equity security of $3,500 is not recognized for tax purposes. So let's see if they go on to give us the basis. They tell us that it was reported at $10,000 for GAAP. So remember, this is the investment, right? I don't really need to do the math here because they've also told me that the difference between the two, right, that gain is $3,500, right? That gain is baked into this $10,000 over here. So if I wanted to put the tax book, I would do $6,500 over here. All right, so now I've got 3 differences that I need to deal with. First thing I'm going to do is multiply them all by 25%. That's our tax rate. All right, let me do that math really quickly. Okay, so for the $20,000, that's going to be $5,000. For the $12,000, that's going to be $3,000. And for the $3,500, that's going to be $875. Okay, so now we know. Next question comes down to, are these DTAs or DTLs? And again, this is a really good chance for you guys to use some of the notes that you've got from the PowerPoint or the book, right? But in general, one pattern that I'm noticing is that when those differences are positive, we end up with DTLs, versus when it's negative, right, which it would have been here because we had 2 liabilities, right, we end up with a DTA. But again, I encourage you to use your book and your list of items there versus trying to do the in and out of the GAAP versus tax income the approach I was giving you in class. Okay, so now we've got a DTA of $5,000. We've got 2 DTLs that total up to $3,875. Let's put our journal entry together. We're going to debit tax expense. Have we been given this piece of information? No, we have not, because it hasn't given us our GAAP income. So we'll put a question mark there. We do know we've got a debit to the DTA for $5,000. That's this number up here. Right, we know we've got a credit to the DTL, the sum of the $3,000 plus the $875. And we're going to have a credit to income tax payable. Now, they did tell us that taxable income was $60,000. Okay, great. We've been given this number, right? That's important because we need to solve for the tax expense. So we'll have the $60,000 times 25% equals $15,000. So with that, I can now solve for the tax expense, right? So to balance my entry, what do I need? I need $13,875. Okay. They also say record the income tax journal entry on December 31st, 2021, assuming taxable income was $125,000. So here, I'm trying to go back and read the question. They're giving us enough information in items 1 through 3 to say that all of these pieces will reverse. Let's see here. Yeah, so let's give that a try. So I'm going to insert a new slide so we can do that. So now again, we've got taxable income of $125,000. What's that going to drive? It won't drive the tax expense. It'll drive the tax payable. So we've got taxable income equal to $125,000. All right, now I'm going to have to, I don't know why that's doing that. Try to get that off of there. All right, so let's start with the litigation accrual. So the litigation, now remember we're in 2021 now. I've got a GAAP and I've got a tax book. So for the litigation accrual, it told us in number 1 that the settlement will take place in 2022. That means for GAAP, we've got a 0 basis, right? And settlement not expected till 2022. But we're in 2021. Usually that would mean that we've got some kind of difference we've got to deal with. But nope, here I think what they're trying to tell us is, hey, it looks exactly the same as last year, which means we have not settled it yet because we're just in 2021, not 2022. So I still have on my balance sheet the $20,000 accrual for GAAP and 0 for tax, which drives the $20,000 difference times 25%. I'm still going to need a DTA of $5,000, ending balance in the DTA of $5,000. Remember, we're going to compare in a minute and see if we actually have something already there. Next up, draw my T accounts again. So this was litigation. Okay, the next one is the depreciation. So what they told us last time is we had a $12,000 difference between GAAP and tax, but 1/3 of it would reverse. So we can shortcut that. 1/3 of the $12,000, right, is $4,000. Right, so we should still have an $8,000 difference, right, because we've got 2/3 of this left. Oops. All right, so we've got a difference of $8,000 left, right, which is equal to 2/3. Multiply that times 25%. That's going to be $2,000. And because assets, right, sit on that side of the balance sheet, this will end up going to DTL. And then lastly, they told us for the investment, we've sold it now, right? So last time we had a difference between the fair value and the tax value. On the investment, we've sold it. So it's 0 and 0, which means we have 0 difference, and we don't have any need for the DTL there. Now, here's what's different this time around. In that previous slide, remember, we didn't have any starting balance in the DTA and the DTL accounts. which made it super easy because our journal entries equaled our differences. Whereas now we have a balance. We're going to look what that balance was from the previous year end, right? So we have a DTA account, we have a DTL account. Our DTA account, here was our entry last time, $5,000. It's the only entry we made. So we have a starting balance in the DTA of $5,000. We want an ending balance of $5,000. So there's no adjustment needed to the DTA. For the DTL, we had $3,875 balance from our entry last year. So that's our beginning balance, $3,875. But this year we only need a $2,000 balance there. So how will we do that? We will debit it $1,875. So let's piece that entry together again. Okay, debit tax expense. Can I write my tax expense number in yet? No, because I haven't been given that GAAP taxable income. I only have the taxable income. I don't have an entry to my DTA because notice we didn't need it over here. I do have a debit to the DTL. This is the adjustment we came up with here. And I'm going to record my tax payable based on the tax expense number they gave us of $125,000 times 25%, and that's going to equal $31,250. Can I get to my tax expense now? Yes, I can, because it's just what I need to balance the journal entry, which will be $29,375. Okay, if you have any questions, don't hesitate to reach out. Again, I'm going to just hope it doesn't cut me off, but I'm going to go slow in turning